So about 5 months ago, I made a video that was titled New Investors Lose Millions Every Year Because of This. And essentially what I went over were different traps in the markets, more specifically value traps. In that video, I highlighted some of the things to watch out for when we're talking about value traps, and I even gave a few examples which you can see in the thumbnail right there. Teladoc, Ford, AT&T, and GM. In today's video, we're going to follow that up with a part 2. And I'm going to be going over a few other things to watch out for if you're a new investor or a seasoned investor. If you want to save money in the future, preserve your wealth, and hopefully grow your portfolio over time, then stick around. But before we get into that, I always do a portfolio update. So as you guys can see on your screen right here, this is my dividend portfolio. It's currently sitting at just under $91,000. And continuing the series that we're on, Road to 1 Million, I'll be tracking this portfolio that you see on your screen right here all the way to $1 million. If you guys want to see my trades, which are typically weekly, and you want to see what it's like to invest in the real world for the long-term gains, then stick around and consider subscribing. Taking a look at the all-time gains for this portfolio, it's currently up 51% or $30,000. Year to date, the portfolio is doing extremely well and it's up 45% or $28,000. So to say it's been a good year would be an understatement. Before we get into the main part of this video, I just want to point out I did make another $1,000 buy of Visa stock. So that gave me another 4 shares at a price cost of $249 per share. This holding is currently sitting just under $9,000 and it makes up roughly 10% of my portfolio. With that out of the way, let's jump into the first part of this video, and it's something I want to talk about, and that is free cash flow. First example on today's list, and that is a company called ChargePoint Holdings. Some of you may be familiar with it if you have an electric car. If not, essentially this company makes charging ports and equipment so that you can charge your electric car. They're domestic and international. Additionally, all the companies that I'll be going over today, the reason that I picked them is because they were some of the most traded stocks in the market for the last week. So clearly people are buying into these companies. Why might somebody be buying into these companies? Well, for one, I think it is the price of the stock. Less informed investors see a stock going for $2 and they think it's more affordable. They rationalize the buy in their head that they can buy more shares of this stock rather than buying a much better company like Microsoft, Apple, or Costco. Moreover, it's not uncommon for these individuals to not look at any of the financials of the companies that they are buying. I'm sure if they did, they would regret that decision and sell it immediately. So first, let's take a look at the valuation section. This company's market cap is $810 million. Their cash to debt ratio, they have $233 million of cash on hand, but they're in debt $295 million, which nets out to $62 million in debt. Not as bad as I would have expected, but let's keep taking a look. Year to date, this company is down bad. It's currently down 76% year to date. This company went from trading at $12 per share all the way to $2 per share. Anybody that bought up here, well, they probably lost a decent amount of money. Taking a look at this company's revenue, it looks pretty good. If we look down here at the bottom, in the last year, their revenue increased by 93%, and in the last 2 years, it increased by 78%. 2023 revenue was $468 million. So you may be thinking to yourself, well, clearly this company is making money. I don't understand how this could potentially be a value trap or a bad investment until we look at something called free cash flow. Now this chart looks a little bit different for one main reason. These graphs are not going up, they're actually going down. So year after year, this company is losing more and more money. Think of free cash flow as how much the company actually makes. So when we're taking a look at the revenue and it says they made over $400 million, well, we take a look at the cash flows for 2023 and they actually lost $285 million. Now let's see if a company that's losing $285 million is paying stock-based compensation to their executives. And wouldn't you know it, they are. So while the company is losing $285 million, they're paying their executives $93 million for that year. That, my friends, is another form of dilution. They are diluting the shareholders. Switch this to the adjusted free cash flow and you can get a better grasp. Include that stock-based compensation, and this company actually lost $378 million in 2023. This is just one of the many red flags you need to look out for as an investor. These companies can be very deceptive, and if you don't have the tools to analyze the financials, probably worth heading the opposite direction and not investing your money. Another great financial metric that you definitely want to take a look at, and that is shares outstanding. Contrary to the revenue and the free cash flows, you do not, I repeat, you do not want to see that this chart is going up year after year. That means that the company is issuing new shares, therefore diluting you as the shareholder. In layman's terms, the more shares they issue makes your stock that you already own worth less and less. So in the last year, this company increased their shares by nearly 12%, and in the last 2 years increased it by 10%. That's pretty high. They went from, in 2022, having 302 million shares outstanding to, in 2023, upping that to 338 million shares. Again, this is not something that you want to see as an investor, and these are companies that you want to watch out for. Now, it is worth noting there are some circumstances where companies issuing new shares are for the right reasons. In my personal opinion, after looking at the financials of this company very briefly, this is not a company I would want to put my money into because I don't think they're issuing these shares for the right reasons. Let's take a look at another very well-known company that has a very high trading volume, and that company is American Airlines. We've all flown it, and they have great brand recognition. Because of that, a lot of people buy into the stock. But if we take a quick look at their financials, we'll see that this is not a company you want to invest your money in. For instance, the valuation section, we take a look at this company and they have a market cap of $8 billion. That is a sizable amount of money. We go over to the balance section to see their cash versus debt ratio, and they're actually negative. They're in debt $17 billion, and that number only continues to grow. How's the stock performing this year, you may ask? And I would say pretty flat, if not bad. The company is currently down year to date 2.59%, so you could say that this company was trading relatively flat for the year. But if we look at this chart, we can just see large swings in the market, a lot of cyclicality. For many investors, new and seasoned, this is not something that you typically want to see. It invokes emotion, which therefore encourages you to either buy or sell when you really shouldn't have. Putting that aside, let's take a look at the revenue real quick. So it looks pretty good as of right now. The revenue has been increasing with a minor dip in 2020 for obvious reasons, and then it shoots right back up. But when we take a look at their free cash flow, it paints an entirely different story. It's either flat or in the negative with slight jumps of positive free cash flow. For a company that has a market cap of $8 billion, this company in 2022 actually lost $733 million. Switch this to the adjusted free cash flow, which includes stock-based compensation, and we can see they actually lost over $800 million for 2022. So while the company was losing over $700 million for the year, they decided to pay their executives $78 million. Now you tell me, does that sound like a smart financial decision? Is this a company that you would want to invest your money in? Taking a look at the metric we just covered, and that is shares outstanding. And let me just say, wow. This does not look good. Typically for these charts, you don't see a lot of cyclicality. You don't really see a lot of ebbs and flows, huge jumps and huge dips. But for this company, that is the contrary. Now I'll give them the benefit of the doubt. Maybe there was a huge acquisition that they made, so they needed to raise cash quickly. But as you can see, they are still diluting their shareholders. From 2019 to current day, they are increasing their shares outstanding every single year, further diluting your shares and making your stock worth less. Taking a look at another very popular company, and that is Intel, a company that has been around for a very long time and makes pretty good products. They're known for making chips, which have been really good over the years. But again, this is a company that you have to take a look at the financials and really decide, is this a company I want to invest my money in? Doing the same thing as the others, we can see that their market cap is $184 billion, so a substantial jump from the companies we were just taking a look at. Intel, if we compare their cash to debt, is currently in debt $21 billion, and year to date the stock is actually up 69%. So if you were invested in this company, you did really well. From 1985 to current day, this company's revenue looks very healthy. Year after year it's going up, with a large dip for 2022. So that's something that should be alarming for investors. You want to take a look at why that happened. And if we take a look at the free cash flow, it was actually really good for a long time. Essentially from 1995 to 2020, the free cash flow was growing pretty substantially. with a huge peak in 2020. From 2020 onward, things got really bad. It dropped off a cliff, and they went from in the positive $20 billion to in 2020 negative $9.6 billion. Again, let's see if they're paying stock-based compensation during this time, and yes, they are. So the company lost $9 billion, and they also paid $3.13 billion in stock-based compensation to their employees. Let's take a look at the adjusted free cash flow, and we can see that in 2022, this company actually lost over $12 billion. Not very enticing if you're an investor in this company. Taking a look at the dividend, because Intel was known for its dividend for a very long time, and you can see they actually cut it by a substantial amount, even when their CEO came out and said that they would not cut it, and then a few months later did exactly that. Now, I promise this video is not going to be all bad news. We take a look at the outstanding shares, and it's actually looking really good. Intel is making a huge effort to buy back their own shares. Now, while this may artificially increase the price of their stock, it may not be the best financial decision for this company, especially when they're in debt and their free cash flow is in the negative. It may be time to put that money towards other uses. Lastly, we'll take at another company that has a very high trading volume, and that is a company called NIO. It's a Chinese company. They make electric cars that actually look pretty good. Stock is currently trading at just $7 per share, so it may be enticing to some, but when you dive into the financials, it paints a different story. With a market cap of $13 billion and a company that actually has $22 billion in cash on hand, which is very high, this company has just not had the best year, with huge ebbs and flows in the stock price, and year to date being down 19%. So while other companies are up 45%, 50%, and even 60% year to date, you have a company like this down 19%, but people keep buying into it. Again, revenue looks great. Year after year, it's increasing. Taking a look at their free cash flow, we can see that it has historically been negative, except for 1 year in 2020 where they made roughly $700 million, and that is excluding the stock-based compensation. We can see in 2022, the company actually lost $10 billion, but they paid their employees $2.3 billion in stock. Are they diluting shareholders by increasing their outstanding shares? And the answer is obviously yes. So what is the point of this video? And I'm sorry for any shareholders out there. My intent was not to increase your fear, worry, or anxiety in the stocks that you own, but to spread awareness. Spread awareness for the seasoned investors and the new investors of, hey, these are the companies that you are putting your money into, and these are some things that you might want to watch out for in the future. It's no secret, one of my favorite companies in the market is Microsoft. If we compare the companies that we just took a look at to a company so well ran like Microsoft, it gives you an idea of what you may want to be buying into in the future. Revenue increasing year after year, free cash flows increasing year after year. So that's how much the company actually made. And this is with stock-based compensation included. So the company is still profitable by a large majority. The company is continuously buying back their own shares, not putting the company in financial hardship or wasting cash. And they are consistently paying out a dividend every single quarter. So going forward, let's do a little recap. What are the things that you want to watch out for when you're investing in a company? Number one, I would say free cash flow. Free cash flow, free cash flow, free cash flow. That will tell you if a company is actually profitable. And it's also nice to see if a company is down for the year, how much they are paying in stock-based compensation. It's a good indication to see if they have a greedy staff or it's just mismanaged, and it lets you know, hey, this company is doing the right things. Second on that list, and that is shares outstanding. Is this company diluting me as a shareholder by continuously increasing the number of shares out there? If they are, is it for the right reasons? Do that research. And number three, if your company is paying a dividend, can they continue to pay that dividend in the future? And are they putting themselves in financial hardship by doing so? If the answer to that question is no, then that's a good sign. If you guys enjoyed the video and you want to see more in the future, or you have any questions about some of the topics we covered today, leave them down in the comment section below. Of course, if you got value out of this, feel free to subscribe, like the video, and I will see you in the next one. Take care.